All right, ladies and gentlemen, investors of all walks. My name is Seth Golden, and I am joined again today with Brad Carter here for our weekly State of the Market presented by Phenom Group. If you're not used to our logo by now, it took us quite a while to pick this logo, but we really fell in love with it. You know, when we finally did, we played with the colors and what have you, and probably not what we wanted to talk about here on this week's State of the Market. We probably want to start talking about this, it's some consolidation going on here. As a reminder, Phenom Group, we put out a weekly research report that goes out Sunday to our contributor and premium members. And the title of last week, I don't think is any more appropriate than what we're experiencing here week to date, which is don't worry, be happy about pullbacks and uptrends. I mean, as I always say, as an investor, you want to be playing chess. That you want to stay one step ahead. What's the next move? And we try to keep our subscribers ahead of the market, thinking ahead, training our minds. It's just a really good exercise. So we anticipated some consolidation. The market is not going to go up in a straight line, folks. We're still bullish, but we want to take advantage. That's why I say, don't worry, be happy when we have these pullbacks. How do you feel about, kind of the state of the market, where we are year to date, Brad, and this really choppiness that we're seeing here this week? We had a great day going in, on I guess it was Jerome Powell's speech day. The previous day was down, and coming out of Jerome Powell's speech day, here we are in the red.
Yeah, and on Fed days in general, the market tends to go in both directions. If it opens sour, you go buy because it's going to change. It's fairly predictable, and I think the same thing kind of happens with these speeches. That you focus on one part of it one day, and the next day if you were thinking positive, now you're thinking negative. But the way the year started in general, I thought January got off pretty darn hot, hotter than I expected. Even though I expected things to get better in January, but when it ran as much as it did, I didn't put too much more money into it because I thought, we're gonna have consolidation, like you said, and I think what you've got to do this year, if it's a choppy year like this most of the year, which I'm kind of thinking it might be, you can really take advantage of that by holding on to plenty of cash so that you're within your comfort zone and buying those stocks that you really know when they're on sale, and taking a little off the top when they run a bit, and it's wash, rinse, and repeat.
I think it's going to be choppy as well, and the active portfolio manager can make out like a bandit in that market if the overall trend is up. And year to date, we've got all kinds of confirmation signals, trend following signals, et cetera, that are suggesting this is a real uptrend. This is a real bear to new bull market. What I have been seeing a lot lately is those technicians, those certified market technicians, right? Who lay claim to price is truth. They tell you, we don't look at the fundamentals. The technicals tell you what the fundamentals are. So, that we don't pay attention to the macro. That's all in the price. It's all in the technicals. But like every day, on CNBC, just last night, Jonathan Krinsky of BTIG, he comes on defending his bearish case, suggesting this is not a real new bull market. There's still work to do until you declare a new bull market, and he thinks we're going back down, possibly testing the lows. And when he was pressed by the judge on CNBC, his retorts were all macro, but the macro, but the Fed, he said over and over again. It just, if the technicians are going to have this dogma for decades that price is truth, then why are they doing this now? Why are they leaning on macro to kind of assuage the bullish technicals and validate their bearish bias? They're giving up on their discipline almost, it seems like. I do want to highlight that because it's disingenuous, and once it reminds me of the I buy gold because it's an inflation protection. Now, how'd that work out for you in 2022, right? They say all these things until it doesn't work or until it just doesn't favor their bias. But when I watched that segment, with Jonathan Krinsky last night on CNBC, I was like, well, here's another one. And because I had tweeted it out, show just a week ago, because it's become so prevalent that and so obvious. I'm like, what are these guys doing? They're technicians. Why do they keep talking about macro to validate some bearish thesis? This was on January 20. This was last year at the very end of the year, January 28th. I'm noticing that a ton of CMTs, certified market technicians, who I also describe as problem seekers. They're always looking for a problem in the market. But noticing that a ton of CMTs postings or tweets are now more focused on macro factors than the technical achievements, or excusing the technical formations based on macro factors. Because very late in the year, we started seeing some real signs of bullish breadth, and we're getting that breadth divergence. I'm sorry, January 20th, the end of last month. And here, I posted it. Lack of downside for the dollar, like that's a big macro. And in time and time again in this interview, Jonathan Krinsky mentions macro. And the judge was like, "Well, I know you're a technician." He couldn't stop himself. So, it's just kind of a recent example of that for those who maybe didn't believe that this was going on, and it really is. Getting a little sidetracked here, but some of these things, it's important to understand because we get a lot of our information flow. We gain our understanding of broad market participation sentiment from the financial media. So, when you have this kind of gut instinct that things are changing with these technicians, there's a different dynamic there. When there's an opportunity to kind of validate that, it should be important to, confirm.
Seth, I barely look at technicals at all. The one technical that I pay attention to on any holding I have is just the chart. Just the chart, 20-day moving average, 50-day moving average, that kind of stuff.
Right.
Because if the fundamentals are good in the economy, if the fundamentals are good in the stock and the stock is down, it's a buy.
Right. And that's what the technicians would lead you to believe, that, and it is, I don't discount that there are some unique characteristics to the bear market in what is, potentially a new bull market. Price led to the downside last year. The technicals led the downside. The macro was fine. In the rearview mirror, I think we can all agree the macro was fine. There was a lot of worries. There was a lot of concerns about a recession. It didn't materialize. So it was fine. But price, the technicals did, move to the downside. And so,
but to me, that sentiment, that worry, is just another fundamental to look at.
Yeah, there was fundamental concerns, which is moved the technicals lower and lower and lower. Yeah, and that's the thing people should understand. It starts with the fundamentals. Like when a stock is going to IPO, there's no technicals, folks. It always starts with the fundamentals. No matter what Carter Braxton Worth wants to tell you on CNBC, it always starts with, as he says, the fundamentals. Because if you genesis, a new issuance, an IPO, there's no chart for price. It's valued against the fundamentals. Everything thereafter, you can make some kind of argument as to technicals leading. So I get it, but there is no argument. It would start and always start with the fundamentals, so to speak. All right, our logo here, or our picture here, and some of you may have been very familiar with this book. It's Why Smart Investors Fail and How to Tilt the Odds in Your Favor. Heads I win, tails I win. Again, a lot of you have read this book, but if you haven't, there's a really good phrase or paragraph within the book that speaks to Peter Lynch. And most people know by now, I'm a huge fan of Peter Lynch. In some respects, I model, my investing exercise, my investing regiment, my trading regiment from Peter Lynch's management of the Magellan Fund from 1979 to, I think, 1991. And here's the paragraph that goes, during his tenure, Lynch trounced the market overall and beat it in most years, racking up a 29% annualized return. But Peter Lynch himself pointed out a fly in the ointment. He calculated that the average investor in his fund made only around 7% during the same period. When he would have a setback, for example, the money would flow out of the fund through redemptions. Then when he got back on track, it would flow back in, having missed the majority of the recovery. And that's the problem. People get nervous when they see corrections, bear market conditions, even bear markets, and they want to pull money out of the fund. And then they think, well, when things get better, I'll put the money back, because it's a matter of confidence for them. The fund, if you just set it and forget it, with Peter Lynch behind the wheel, it gained 29% annualized. But most people missed out on the majority of those gains. And that's why the title of the book is Heads I Win, Tails I Win, but Why Smart Investors Fail and How to Tilt the Odds in Your Favor. The investors still made money. So it was still a win-win, but they lost a huge amount of the total annualized returns that Peter Lynch was able to capture within the Magellan Fund, just keeping the money in the fund. And most people were uncomfortable because Peter Lynch, he had double-digit drawdowns every single bear market, every single correction. He was down more than the market corrected, because he understood there's no way that he would be able to time the bottom. And so he didn't even attempt to. He liked the stocks that were in the funds. He liked the composition of the fund. And so he just wrote it out and used the additional capital in the fund, the cash on the sidelines, to continue to leverage at cheaper prices. And when you're leveraging at cheaper prices, as the market is going down, you're obviously going to go down that much more. Thing is, when the market rebounds, you're going to compound the gains in the fund as the market goes ever higher. And that's, again, just a textbook lesson of stick with the market. If you have good stocks, and nowadays we have ETFs, we can diversify to a greater degree than Peter Lynch could back in his day. He had to be a good stock picker. He had to be a good sector picker and kind of know his cycles to the degree that he knew at the time. So stick with the market, folks. Trying to get in and out, you are going to miss a huge chunk of the gains. 29% for the Magellan Fund on an annualized basis, but his clients, the average only generated 7% annualized. One of the things I wanted to focus on also here this week in our State of the Market is everybody seems to have a checklist. Everybody knows the conditions for a bull market, right? JP Morgan has their checklist. Bank of America has theirs. Even, what's his name? Ray Dalio of Bridgewater has his own, checklist that tells you it's a new bull market. Everybody knows everything. But and this is awesome, folks. This was the checklist for Bank of America. And they put it out or published it back on, look at the date, folks. Does anybody remember what this date signifies? Mike Zaccardi, he was kind enough to publish it and tweet it, I should say, on Twitter, October 13, 2022. And he says only 20% of the signposts triggered versus over 80% before prior market bottoms. Everybody knows why I posted this now, right? And why we're talking about it, because that proved to date the ultimate low of the, if you believe we're still in a bear market. That was the low on that day. You want to talk about probably what might go down as the most contrarian bear market checklist in history. This could be it, folks. At the time, it said, nope, only 20% of the market bottom, boxes have been checked. And yet, look what the market did once it hit that October 13 bottom of just under 3,500. So keep that in mind, folks. That's Bank of America, which is typically bearish. Their lead equity strategist is Savita Subramanian. Right, she's got a price target on the S&P. I think it's 3,600 for this year, maybe 3,800. I'm sorry. She sees a recession happening. She sees it as inevitable. She said we were going to get off to a very rocky start in January. Well, I mean, things are not looking good for Savita and the team at Bank of America. And don't get me wrong, the year's not over. It's still very early. Anything can happen. But, in terms of the near-term outlook for Savita, completely wrong. And in terms of this checklist, it's not looking good. It's not looking good. This is one from Oppenheimer that I had actually introduced to the Phenom Group members. I want to say in September of last year. And at that time, this is their checklist suggesting a market bottom. And at the time, only 1, 2, 3 items had not checked off. Now, ever since then, that was September of last year, every single one has checked off. The peak to trough duration needs to be about 7 months. Well, after September, it was more than 7 months. It was 9 months. So that one got checked off. NYSE net new highs are 1,000. We completed that one as well. And the last one was the put call 10-day average, greater than 1. Well, we did that pretty much through the whole fourth quarter. So all of them got checked off. To my point, everybody's got a checklist. Here's Bridgewater's checklist. Inflationary U.S. equity bear markets and what you want to see in terms of moving from a bear market into a new bull market. One of the things that I, like to see in terms of, I've got 10 signals that I look for when it comes to moving from a bear market to a bull market. One of them is I want to see small caps lead off of a major low. So, down more than 20%, and then we rally some 10, 15, 20%, which we have. We've rallied 20% off of the lows on an intraday basis. But what's leading? Historically, out of bear markets, small caps lead. They led out of the Damian bottom, the 666 bottom in 2009. The European debt crisis, which was a 19.8%, a major correction in 2011. The small caps led the way. The QT bottom of 2018 was another 20% technical bear market, and the small caps led the way into 2019. 2022, here you go, folks. Small caps led the way. The only time the small caps didn't lead was the COVID bottom. Why? It was a special circuit. We needed everything digital. Everything was being done on the internet. Everything was being done at home. So all the technology, all the information technology and communication stocks led the market. That was the only time. And we can understand the why for that circumstance. So when I'm looking for a new bear to bull market, this is just one example of the 10 items on my checklist. But having said that, all of my 10 items did check their boxes. And this was Bank of America. Again, this was their lead strategist for just the US. Michael Hartnett, which a lot of folks are familiar with. He says one way or another, the S&P 500 is going to retest 3,600, likely break to new lows and deliver deep value for savvy investors. We'll go back to 3.6 or 3,600, at which point Hartnett reminds clients of his favorite 2022 phrase: nibble at 3,600, bite at 3,300, and gorge at 3,000. So, he thinks you should be buying the dip. But at the same time, that would be once again, a really humbling experience for market participants if we get another retracement all the way down to those levels. JP Morgan, typically bullish historically. I mean, I've been following and I've been a subscriber to the JP Morgan research team since 2016. And I've never known Marko Kolanovic to be a sell guy. You need to be a net seller as opposed to a net buyer. But in Q4 of 2022, he flipped the switch from, we still think that there's an opportunity to rebound. So investors would be well advised to buy the dips, buy the value below 4,000, below 3,900, below 3,800, so on and so forth. But then in the fourth quarter, he basically threw in the towel. He believes that a recession hasn't been fully priced. He believes the Fed is going to, stay higher for longer. And that the earnings outlook isn't as strong as he would like to see it. Therefore, he thinks you should be selling this 2023 early year rally. Again, this is very, unlike Marko. And wouldn't it be? He didn't do this in 2018. In 2018, when the Fed was hiking rates. In 2018, when the Fed was doing quantitative tightening, Marko was still saying buy. And he was right to do so because, within the first few months of 2019, when the calendar year shifted, everything that we lost, we gained almost all of it back within just a few months. And we had a breath thrust. So he was right to stay the course. It does, beg for investors to question, why this time has Marko basically become a turncoat, if you will. So any comment there, Brad, on what we're seeing from the analyst community, and how do you maybe digest some of the analyst and strategist commentary week in and week out?
Well, first, let me emphasize that I try not to read too much of it.
Yeah.
but I do, yeah, because I don't want it messing up with my own psyche and,
right.
and the way I'm approaching the market. But it's good to keep all of this in mind because we don't know what exogenous event might lead one or two of these bearish guys to be a little closer than we thought they might be. I doubt it. The thing I'm looking at the most is we're not going to have a recession unless inflation turns back the other direction and the Fed responds without some other major event.
The Fed gets spooked, yeah.
But here's what you got to like about what's going on right now. Inflation is coming down while jobs remain strong.
Very strong.
That is such a perfect combination of circumstances.
Right.
If that keeps up quarter after quarter, there won't be a recession. There can't be. Yeah. You can't have a recession with a job shortage.
Right. And most people when you tell them, and they're always moving the goalposts, right? The recessionistas, you have this conversation with them, they move the goalpost to yield curve inversion. We're like, buddy, you can't have. It doesn't matter that the yield curve is inverted. The yield curve has been inverted now for what? 6 months, 7 months.
Long time.
We're still growing jobs. We still have an influx of, because people always associate the service sector of the economy with, hotel, because it always gets the headlines, leisure and hospitality, travel. What doesn't get the headlines is financial services. That's the biggest component of the services industry. They're doing fine. They just reported they're doing fine. Stop talking about the yield curve. You can talk about the yield curve as being that impending doom when, it starts to show itself in financial conditions, which is not showing. It has to show itself in lending, which it's not doing. We just saw, I think we've had 3 straight or 4 straight weeks of a rise in mortgage applications. both refi and new home purchases. So, yeah, I mean, the yield curve usually does signal, but even the kind of the grandfather of the yield curve inversion, signal, he did his thesis, Harvey Campbell said he doesn't believe this time the signal is going to be valid. And people always say, well, 8 of the last 8 recessions, the yield curve signaled the recession ahead of time. What they fail to tell you is that 9 out of the last 8 times it did. Because it was that 9th time that it didn't. And guess what cycle that was, or what year that happened? 1966, 1967. The yield curve inverted. We did not have a recession until, what was it, 1970, I think it was, 1969, 1970. The market did nothing but go higher. 1966, it had a big correction, right? The yield curve inverted literally when the market bottomed. It was like a day or two, the market bottomed after the yield curve inverted. And the yield curve stayed inverted, I want to say 5 or 6 months. And it did not lead to a recession. And the market did nothing but, I think it was up another 20% in 1967. No recession. That's why they say 8 of 8. 8 of the last 8 recessions. And not 9 of the last 8 recessions with respect to the yield curve inversion. So that's why I always say, well, what's your time frame? How far are you going back with these signals and what have you?
And Seth, it reminds me of something else I wanted to. This whole definition of recession, based on the old textbook, 2 consecutive quarters, one could argue that we had it.
They do, but they say that the definition was changed. And that's why I don't like the word definition when it comes to recession, because there's no textbook definition. Well, I mean, I shouldn't say there's no textbook. It's broad-based economic weakness. But for how long is an open-ended question. The time parameters are very subjective. And it has to be labeled a recession by the National Bureau of Economic Research. If it's not labeled a recession by the National Bureau of Economic Research, it won't go down in history as a recession. But I get your point. We did have 2 back-to-back quarters of negative GDP in Q1 and Q2 of 2022. And the bears try to argue that we already had it and, whatnot, or the
and then there's the then there's the weakness compared to what?
Right.
I mean, because of the government response to COVID and all that, the money poured in.
Right.
It was, it was almost like the 1920s there for a little while. Just people had tons of money. People are spending tons of money. Didn't we have a GDP print of around 7%?
Yes. Yeah.
Yeah.
And
okay, so we pull. So you have a pullback after that.
Right. The rate of change isn't it? You're not going to do that on a year-over-year basis. Yeah. Now far as where the market bottom is and all these different. Now I've gone on record. Back in our October 30th research report. I did the exercise using the manufacturing index, the ISM manufacturing index, or PMI, if you will. And I used both forward PE multiples and what trough level we could get to on the ISM manufacturing index, and what that basically would spit out so far as an S&P 500 value. And based on that weight of the evidence approach, it spit out 3,500, which we did last year. Again, my analysis was offered on October 30th in our weekend research report. The case for 3,500 being the trough is strong based on these analytics. But there's no guarantee, as we can't predict economic outcomes. To date, given that the economy is still extremely stable, as you were mentioning, the jobs market is still very robust, I can't suggest that this is wrong at this point, that 3,500 won't be the low. I still don't see, some kind of deep recession that is going to result in, hundreds of thousands of job losses at this point. The economic data just isn't promoting that or supporting that notion. So I went on record last year, 3,500 is a low. So far, I look pretty intelligent. We'll see if the market wants to work with me and the economy wants to work with me going forward. Now, it's not my first bottom call either with Phenom Group. We called the bottom in 2020 as well. And one of the major components that helped us to call that bottom on March 22nd of 2020, literally the day, this is Sunday, the 23rd was Monday. This was inside our weekend research report, which I actually made public, late last year. I think I made it public so that anybody can go, read it and see all the content. But this was one of the things that told us the market bottom has got to be in. There was simply no more leverage in the market. When all assets correlate to one, basically, there's just nothing left. Everything got thrown out. And so that's what happened here, in late March. This rose from February into the March, what became the March bottom. You had everything correlated to one. Everything got thrown out. And that was just one piece of information that led us to believe the market bottom was in, or we were darn near close. So,
hey, Seth, could I chime in where I messed up on that?
Sure.
That year, if you'll recall, somewhere around January, when things were starting to look pretty dicey, I kind of disappeared from the group because I think I may have even told you I was having pretty serious Wi-Fi issues, and I was having a hard time looking at the market and checking into you. And I finally just said, until I get this resolved, I'm going to just shut this all out. So I missed your call about March, and I was winging it on my own and listening to all the wrong people and stuff like that. And as a result of that, I didn't start taking advantage until the fall.
Mm-hmm.
It resulted
better late than
and it resulted in a break-even year when I should have, because I got clobbered in January, when I should have done much better. So that's just a shout out to Phenom. I'll bet you anything, had I still been engaged, I would have at least tempered my pessimism.
Something tells me you did very well since, so no harm, no foul, right?
Yeah, well, and the year before was my best year, so having a break-even year here and there is
right to be expected. Yeah.
If I could take my last 4 years and duplicate that over the next 4 years, I'll take it.
There you go. There you go. Glass half full, right? Okay, so now is this a valid exercise so far as trying to value the potential of a market bottom call using PMIs? Well, history tells us the answer is yes. In fact, one of the most closely correlated measures of a market bottom is the ISM Manufacturing Index, or PMI, Purchasing Manufacturing Index. So this chart from Michael Sembalist at JP Morgan shows you, and here's the ISM, this dark colored dot, and how it shows up next to the S&P 500 in a lighter color. Usually, right, this is very close to a market bottom. See, this is the S&P 500 trend line, folks. This particular cycle, look how close the ISM is to the market bottom. Right, it's the closest. There's GDP, which is just above the ISM. There's payrolls, which is just above GDP. So the closest to the bottom is the ISM. Here again, the closest to the bottom is the ISM. Here again, closest to the bottom, ISM. Well, this is a tie here, housing starts and the ISM. This time here, this was the only time that the ISM wasn't the closest. And of course, it's the .com period. Like almost all studies and quant data, it just didn't work during the .com period. So this is the only time the signal wasn't, or this wasn't the best signpost. Here again, closest to the bottom. And this was 2020. Closest to the bottom, maybe a tie with payrolls. So that is why we use the ISM to, potentially give us a good indication as to, where the bottom of the market might be. Because it also gives you good insight into what the earnings outlook will be. While the economy is largely a service-based economy, you've heard the saying, the economy is not the market, right? And the earnings, the majority of earnings, S&P 500 earnings, come from goods, right? And goods are being manufactured. And that's why we pay attention to the ISM, because most of the earnings are coming from the goods side of the economy, not the services side of the economy. And it's the opposite so far as GDP is concerned. GDP, the biggest constituency is services, goods being far less. And then you got your other. So it's all very sequencing, right? We've talked about sequencing. We look at ISM because we know that has a very direct correlation, with earnings. All right. So moving on. Now, what about what's going on? Because we all know that manufacturing is in a recession. I mean, it just is. The ISM index is below 46, I think. Anything below 50 is a contraction in manufacturing. But we also know from history, the last 30 years at least, and since China has become, a manufacturing dominated region, that China's manufacturing leads US manufacturing, because there's a economic impulse in Asia that bleeds over to Europe, and we get some beneficial tailwinds from that as well. So when I looked at what's going on through the JP Morgan data, relative economic strength better in China, Europe versus the US. Why? This is their composite of leading economic indicators. China, boom. Euro area, boom. Look at this V shape here. We all know why. China just, had its reopening, started on January 8th, and it's just a V shape, folks. And we're getting, remember, if it works in China, it's going to have a tailwind throughout Europe. And now we see the leading economic indicators for the Eurozone area doing their own version of a V-shaped recovery. And here's the PMIs, or, their manufacturing. Same thing, folks. Look at this. And remember, so China's manufacturing leads our manufacturing. Again, we're looking at things that indicate a bottom for the market, even, a recovery, or you can't really say recovery for U.S. economy, but maybe reacceleration in U.S. economic activity going forward. We put this all on the grinder because we're going through the earnings season right now. And it's not great, folks. I'm not going to lie to you. Earnings are down, or trending down on a year-over-year basis for the fourth quarter, about 5%. And we're still annualizing around 223, but the 2023 earnings per share, this is the consensus estimates, just on week-to-week basis, as it's updated every Monday during earnings season, went from 226 now to 224.31. And you can see the 2023 consensus estimates, have been rolling over. But this would still be growth versus what we're tracking for the whole of 2022. It would still actually represent growth. But let's say, because there's a lot of narratives, there's analysts out there that say, this is this is a farce. Morgan Stanley says 195. Some analysts are at 210. Some are at 220. But let's say worst case scenario, you're at 210. That is less than a 10% annualized year over year decline in earnings. The market has never been down when earnings are down 10% or less. Well, it's actually 8% or less. So we have some cushion here. folks. We have some cushion. This is just the data. We're not talking about seasonality. We're not talking about the third year of a 4-year presidential cycle. We all understand that data. The market has never been down since 1931 in year 3 of a 4-year presidential cycle. We know that. A lot of good signals. The market has actually, the economy has never started a recession in year 3 of a 4-year presidential cycle either, folks. And why do you want to stay in the market? This basically tells you. We don't know exactly when the bottom is or where the bottom is. I do believe presently, and since October of last year, the bottom is in. And if that's the case, usually the market bottoms about 4 months, if you are in a recession, about 4 months prior to the end of the recession being called by the National Bureau of Economic Research. About 4 months. Now, again, to your point earlier, Brad, you said a lot of people believe we had a recession last year. Okay. Well, the market bottomed in October, as far as we know. November, December, January, February. We're right on schedule. It's 4 months, folks. But here's the thing. If you don't believe and all you do is try your best to filter all of this negativity from the financial and social media platforms, you're going to miss out on this big rally. This is just the average rally leading up to the recession end date. Forget about what happens after the official end. Look how much you can miss out just to the recession end date being called. That's a double-digit return there. That's right. We've already traveled 20% off the lows. History's repeating. History's repeating. And there's still a lot of people who say, nah, nope, we're going lower. We're going back down. We're going to have a recession. Yield curve, the Fed. They have to be of the opinion that for the first time in history, price is not truth. The reason why we fell 20+% last year was because we just, it felt like it. So keep that in mind, folks. And we've also had this interesting anomaly so far as debt levels, investor debt levels. This basically shows the deleveraging, margin debt. For those of you who are familiar, investors, traders are trading and investing on margin. They did leverage now for 14 months. 14 months of deleveraging. Usually at that threshold, look, that was a bottom, chopped around here, but it was pretty much the lows we're in. Here again, we crossed this threshold, bottom, and we just went higher. Here again, 14 months, bottom, went higher. We're at 14 months now, folks, of margin debt deleveraging. So, again, to my point earlier, what was left to sell? How, things can only get so cheap. The other argument is we have an 18 times multiple set. That's not recessionary multiple. I get your point, but if you were telling me we had a recession last year, Mr. or Mrs. Recessionista, then you have to also recognize that multiples expand, through a recession. That's how it works. Almost every single time. This was the 1980 recession. The PE expanded 5.3%. Here was the 1981-1982. It expanded 8.4%. 1990 recession, 14% multiple expansion. 2001, multiple expanded 11%. 2007 to 2009, the great financial crisis, multiple expanded 8.5%. The only time it didn't expand is because we didn't have time, was the COVID. I mean, you had a month. The multiple didn't have time to expand. The market was up and away. So multiples expand, during recessions. It's how it works. I like to debunk, I do some myth busting, if you will, here occasionally on our weekly State of the Markets. This is, actual extrapolation from the Morgan Stanley team led by Mike Wilson. They issue their weekly update every Monday morning, and this particular graph was one that I found interesting, and apparently social media has found it very interesting. It's probably the most popular one out there right now, and it basically highlights that this year, this is the 5th time since 2000 that the forward EPS is set to decline for the S&P 500. Now, each previous time, so the 4 previous occasions, this is the 5th, but the 4 previous occasions, there was still downside in the S&P 500. Now, this is what I call an interjection, right? That what you just heard is straight from Mike Wilson of Morgan Stanley in their weekly research report. And absolutely everything he said was a fact. But here's the big thing that he might be missing. I give him that allowance because I can't predict the future. But the one thing that he's missing is in none of the 4 previous occurrences where there was EPS downside projected and the market went lower, none of the 4 previous times was the market already down 25% or greater in the prior year, meaning that nothing was priced. There was no recession priced. There was no EPS year-over-year decline priced in each of the 4 occurrences. This time, you can't make the argument that it's not priced because we were down 25% plus at the lows last year. So that could be a nuance that shows a deviation from the script, since 2000. And this is one of those things that gets my goat, Brad. I don't like when people post stuff they have no idea they're posting. And I don't like things that portray negative outcomes when they really don't portray anything. So this chart was published by SoberLook, which is a financial media publication. And basically, stocks do poorly after the last Fed hike when the curve is inverted. So after the last Fed hike, usually you have a pause, right? And if it's really bad situation, then the Fed is cutting immediately, right? So when I look at the chart, I'm like, okay, I get it. I read the headline. This is the median return when the yield curve is inverted after the Fed's last rate hike, hence pause. Market's going down. But Seth, you told us a couple weeks ago, when the Fed pauses, the forward returns are like 14% annualized. That's right. I did tell you that. So this study goes back to 1971. Peru Sajina tweeted it out. Jesse Felder tweeted it out. If you know Peru, bear. If you know Jesse Felder, big bear. So it's no wonder it can be found on these, people's Twitter feed. Well, here's what I asked myself. Okay, this goes back to 1971. This is the forward returns after the last Fed rate hike. What I can't determine is my sample size. Right? This doesn't tell me a sample size. Like, how many times did the Fed pause and then the market went down with the yield curve inverted? How many times since 1971? The chart doesn't tell you that. This graphic doesn't tell it. It could be one. We could literally have a sample size of one that we're talking about, folks, but there's no way to validate it unless you do your homework. So I did the best I could, right? Here I have the 10-year Treasury constant maturity minus the 2-year, so the inverted yield curve, if you will, versus the federal funds effective rate, right? The path of the Fed funds rate. And it can only go back to 1975 on the Fed fund rate. Oh, I'm sorry. The Fed fund rate going all the way back to 1955. But the yield curve data only goes back to 1976, it looks like. But even with only 1976, I got a yield curve inversion here. This does not look like a pause. This looks like immediately they started cutting rates when the yield curve is inverted. Here, the yield curve is inverted again. They were raising rates, they were dropping rates, but there's no pause. So this has to be yield curve last rate hike, but obviously rate cuts thereafter. Yield curve inversion here in 1988, 89, and we know we had a recession, brief one in 1990, but I don't see any rate pause here. I see cuts, and most of us know we still had a flat market performance, no harm, no foul in 1990. Here again, we've got the yield curve inverted, what looks like 2006, and maybe that's a pause, but from 2006 through 2007, the market was up. Slight inverted yield curve here. Sorry, this is 2006. This was 1998. Whoa, I'm sorry. Yeah, this was 1998, where the Fed actually was raising rates. Market still went up after that inversion. Slight inversion, 2006. Looks like they paused, but again, we know what happened after 2006. Market went up through 2007. 2019, we had another slight inversion in 2019 in August, but the market was up through the end of the year as well. So that again, I'm asking, based on what we're studying here, you have to say, okay, yeah, they stopped hiking rates, last rate hike, but that was followed by rate cuts. So yeah, that's a recession and a bad situation. That is different than a pause. So we're distinguishing between just the last rate hike and an actual pause by way of this exercise. And yet there's still no sample size I can garner from what the data is the trend lines are suggesting here. That's the kind of stuff I just don't like seeing, because it's, in my opinion, it's very disingenuous and doesn't give investors a lot of practical utility. So we'll conclude here with Muhammad Al-Arian, right? An expert, right? Because that's what these people are supposed to be, or they're purported to be when they come on these financial media outlets. This one here, this was an interview just recently, 2-3 days ago, I think, on CNBC. Now, remember Muhammad Al-Arian back in 2022. The Fed is tightening into a slowdown. The Fed is tightening into a slowdown. This can't end well. The Fed is tightening into a slowdown. But in this interview, I'm afraid the Fed will be forward projecting, will be tightening into a slowdown. But you told us last year the Fed was tightening into a slowdown, and that was problematic. Now, and he even says in this interview, I have the link here, you can check it. He even says the economy's accelerating. But you told us last year the Fed was hiking into a slowdown. And just 3 months ago, it's not like he wasn't, he was saying this through the bulk of the year. But as recently as December 22nd, Muhammad Al-Arian proclaims the Fed is throwing the economy through the windshield, right? Most of us remember back in December, we had a reported down month-to-month retail sales. We still had jobless claims above 200,000. We had PMIs, manufacturing going down. We had services sector going lower. So it seemed like, things were getting rough. And in this one, he says, in this interview from December, you're throwing the economy, the Fed is throwing the economy through the windshield. But all of a sudden, just this week, the economy is accelerating. Experts. And the problem with, making your decisions based on these financial market participants and media media darlings is they're not going to send you an email. John Smith, by the way, I changed my mind. You're not going to get an email from them saying they changed their mind. So keep that in mind when you're watching these folks on CNBC. Your thoughts, Brad, on what we got going on here?
Some of the charts you were going through, I thought confirmed what my thesis has always been on inflation and the relationship between that and earnings. I think Powell had it about half right when he first said this is due to COVID. This is due to supply chain, China shutting down. This inflation is going to be short-lived. I think the only part he got wrong really is that it's taken longer for that supply chain to refill than he anticipated at the moment. So I'm sticking to my guns that it's all that. And if that's right, inflation is going to keep coming down no matter what the Fed does, because you're going to have more goods in the marketplace. I mean, that's just old school supply and demand economy that helps temper pricing. So if that happens, we can't help but have a good year, and there's no way you're going to have a recession. Having said that, and I know this is on tape, I'm willing to admit that I'm wrong later in the year, because stuff can happen, just like you like to say.
Can't predict the future.
But based on current trends, no, I'm pretty bullish.
Yeah. And, one of the things I love this, Neil Dutta had this article in the Business Insider, and he was basically taking these strategists and so-called economists to task. I mean, he really leveled into them. Neil Dutta is from Renaissance Macro Research. He says, I've been a sell-side economist for over 15 years, helping clients and the public understand the shape of the economy and what it means for the markets. I've always tried to be clear and allow the data to shape my thoughts rather than fit it into my preconceived notions. But over the past few years, and especially since the onset of the coronavirus pandemic, I've noticed that more and more analysts are relying on low-quality, pre-packaged narratives to drum up fear about the direction of the economy and the stock market. Admittedly, stocks haven't done well over the last year, but instead of providing clients and the general public with clear-eyed views, a new ecosystem of hackneyed, alarmist analysts is relying on low-quality data to push people away from steady investments into an alternative ecosystem of products of dubious quality. I mean, fire, right? That is fire. I've been preaching this for a long time. These experts, these folks that, come on CNBC, they come on Bloomberg, and they tell you this is what's going to happen. These alarmists, there's nothing we can do with that practically. Because no matter what they say, we know they are always going to say these things, and yet the market is up 75% of all years. So what's the practicality of that information to me as an investor? Like, if I want to invest capital, I've only got one way to do it, putting it into the market, whether it's the bond or the equity market, doesn't really matter. I still have to put money to work if I'm an investor. And I think what Neil is trying to say is, you're keeping people from doing what will work long term. You're scaring them from allocating capital. Stop doing that. I've been saying that. It's not a matter of where I think it'll go near term. I know where it's going long term. But if I'm so frightened of this near term outlook, based on these alarmist narratives, most people are not going to allocate that capital. Remember, the people that thought that the market was overvalued at 3,500 were not allocating capital at 3,500 last year. They just missed a 20% rally. Full stop. That's where it ends, folks. And they're still waiting for, a pullback, maybe back down to those levels. They have no valid argument whether it will happen or not. It's hope at this point, because they missed such value back then. if we're investing, we've got to allocate capital. It should always be about what am I buying, not what I'm trying to avoid. Manage cash wisely, and you'll always have capital to put to work. You don't like the environment? Cut down your position size when you allocate. So if it goes lower, you can still add at lower prices. Now, that's the book I've been preaching from for many years now. Don't worry about the near term. Trust the long term. The S&P 500 goes from the lower right-hand corner to the the lower left-hand corner to the upper right-hand corner. Make that your Bible, folks. With that, I thank everybody for joining us this week once again here on State of the Market. Tune in next week, folks.